Okay. Let me just get set up here. Testing, testing. Testing. Seems like we're good on my end. Okay. We'll just wait a few minutes while people roll in. Okay. I think we can go ahead and get started. All right. So, Warren Buffett has said on many occasions that if he had to start over, he would invest in small cap stocks. So I came across this article right here. He says that he could guarantee 50% return annually because of the broader range of investment targets available and less worry about market impact when investing. So what are the difficulties? What are the disadvantages that big investors have that prohibit them from investing in small caps? There's a few things. Number one, and this mainly has to do with companies that have lower trading volume. If Warren Buffett comes in and wants to take a big position in a small company that has very low trading volume, just the act of him buying a bunch of shares is going to push the price up to where it's no longer a value stock anymore. So for instance, just recently, Berkshire Hathaway came out with a $5.7 billion investment into Google. Now, a small cap, let's say a small cap is anything between $250 million and $2 billion. Let's just say Warren Buffett was looking at a $500 million company. If he's going to take a big position in a $500 million company, I mean, $5 billion is out of the question. Right? He would be buying the company 10 times over. So how much cash does Berkshire Hathaway have on hand? $381 billion. So number one, they would have to invest in so many small cap companies. They would have to do so much research just to make a small little dent in their cash position. So not only is it a lot of work to invest in a bunch of small cap companies, and yes, this is like a pretty extreme example, but if they are required to buy less than 10%, and I say required, they ideally want to buy less than 10%, because once you have over 10%, they have a whole new set of requirements for, reporting requirements. So generally, Warren Buffett likes to have less than 10% ownership in a company. And a lot of times he'll sell shares, even if the company is doing really well, to stay under 10%. So if a company is doing share buybacks, and then his ownership gets pushed up, he'll sell to keep it below 10%, even if the company's doing really well. Number two, or I guess we're actually on number three now, I started talking about volume. Just the act of buying shares can push the stock price up to where it's no longer a good deal. So when we're talking small cap companies, like less than $1 billion, the big companies, the big index funds, like they're not really taking big positions in these companies. And so what does that do for me? It gives me an advantage because I've got less competition. I've got fewer eyes on a company, fewer people putting money into that company, fewer people pushing the price up. I'm not competing with near as many investors, and I'm definitely not competing with any of the whales like Berkshire Hathaway. They're not even looking at small cap stocks. So as a individual value investor, I am turning my attention to individual small cap companies. Now, you may have heard that in general, small caps tend to perform better than large cap companies over long time horizons. That's mainly that when you hear that, they're talking about like a broad, diversified range of small cap companies. I'm looking for specific, very, very deep value small cap companies. And I'm just way more likely to find those. I'm way more likely to find deep value if I'm looking at small companies. So that is the goal. That is my latest strategy, I would say, for finding deep value companies. And so one way that I'm going to try to do this, there's a couple different methods that I'm going to be experimenting with. But number one is setting up a stock screener. And I'm going to be using a few different types of stock screeners. But the first one I'm looking at, it's very basic. It's just looking at companies under 10 billion. So this is going to also include mid cap. And I'm just going to go by industry. That's what I've been doing. I'm not going to go through the grind live, because I've already been through the grind for software and application companies. And I've already found one that I'm really excited about. And so that's the one I'm going to be focusing on. But what I've been doing is just going industry by industry just to kind of reduce the list. And I'm just focusing on companies that are growing at all levels. So growing their revenue, growing their gross profit, growing their operating income, just over 5% over a 5-year period, and gross margins above 35%. And then I'm not restricting anything by trading volume, but I wanted to include this here because I am curious to see what the trading volume is, because companies that have tons of trading volume, I guess in a sense it's a red flag. They're just less likely to be deep value. It's not saying it's impossible, but I'm focusing more so on companies that have very low trading volume. Hey, Okage, how's it going? Okage says, hello, Brian. Aren't small caps targeted by bear institutions like Hindenburg Research? Yeah, I mean, I think you're right. I guess I wasn't aware that bear institutions target them more or less than larger companies. I guess they can have a bigger influence. So now that you're saying it, and I'm just kind of thinking out loud, if a company has lower volume, then yeah, I could see how they could be targeted by a bear institution. That's possible. Now I haven't thought through this 100%, but my gut reaction is if a really strong company is pushed down in price by a bear institution, if they are indeed a really strong company, then I would think that would only be a temporary problem for that company, and a temporary problem for me as an investor. And it might even be more of an opportunity for me to get in at a really good price. I guess I would have to look more into, lasting impacts from, being targeted by a Hindenburg or something like that. Especially if it's not grounded. Now, if they are having legitimate criticisms of the company, then, I'm happy that they would post their research so I could get out. But that's an interesting concern. Okage says, because the amount of money needed to manipulate the price is lower. Yes. Okay. Just some side thought. Of course, strong companies can hold out if they have enough cash flow. Yes. So if they are depending on their shareholders for liquidity, like if they're issuing shares and that's like a meaningful source of revenue for them or financing, then I could see how that would be a problem if their share price went down, or if they had some kind of some kind of asset leverage that they were using to get loans or credit or something like that. I could see how that would be an issue. But to be honest, I don't know. I haven't not given that much thought. So maybe that's something for me to look into. But in any case, small caps, because they get less volume, because they get less attention, it's just way more likely to find deep value. So in fact, probably the company that I am maybe the most bullish on is actually it's a very small cap company. I think, Hokage, you probably remember me bringing this company up in the past, New Lake Capital Partners. This is just one example. Market cap, $260 million. So they are just above the threshold for micro cap, I believe. And unfortunately, I was not able to invest in this one on my public YouTube portfolio because they trade over the counter. They are not on a major exchange yet, because this is a cannabis touching company. This is a real estate investment trust. But yeah, this is one of the most bullish companies that I'm invested in right now. And it is a micro cap with a small cap with only 8 employees. But I did a video on this one already. So if anyone is interested in seeing my due diligence on this company, You should check that out. Anyway, but for this video, so essentially I'm just setting up these basic parameters. I'm going down the list. I'm putting every single one of these tickers for software application companies into my automated discounted free cash flow spreadsheet. The one that I found that appears to be such a deep value is Yalla. So let's go back to my screener really quick. So like I said, I'm just looking at high gross margins with some amount of revenue growth at least. And I'm just painstakingly going through each one of these. Yalla Group Limited is right here. It is a $1 billion company. So it is a small cap company, and they have their margins, revenue growth, gross profit, and operating income are all pretty significant growth. Their gross margin is 66%, which is really strong. And then their average trading volume is 400,000. So that is healthy trading volume for a small cap company. See, if you're in the tens of thousands, then that is very low volume. And that might be the next screener that I experiment with, is just purely low volume stocks. And this is the 20-day, I believe this is 20-day average volume. Let's see, what is that? Yeah, average volume over the last 20 days. So that's what we're looking at. The stock I found is Yalla Group. So this is an interesting company. Let me go to the overview really quick. All right, so Yalla Group Limited, together with its subsidiaries, operates a social networking and gaming platform in the Middle East and North Africa region. The company offers mobile applications, including Yalla, a voice-centric group chat platform, Yalla Ludo, a casual gaming application. Its platform provides group chatting and game services, and consume virtual currencies to purchase virtual items. So some microtransactions and things, as well as provides upgrade services. So this company is social networking and gaming in the Middle East and North Africa, which is like, before I was really focusing on small cap companies, a company like this would have never been on my radar. I have definitely a United States bias with my investing. And there's nothing wrong with that, to invest in companies that you are familiar with, companies that you interact with even on a daily basis, companies that you enjoy their service and you use. That way you can always keep tabs on the quality of their product, which is something that I do not have that kind of advantage with this company, because I'm so far removed from it. But as you are about to see, the numbers speak for themselves. So I'm really excited. Let's move on. Okay. So Yalla Group. So let me pull up their presentation really quick, just so we can see. So here it is. Yalla Group, their third quarter earnings presentation, November 2025. So we've got some recent information. So here are their advantages. Everything is in US dollars, so I didn't have to do any kind of currency conversions. They have the first mover advantage. So this is an underserved area, basically, where mobile games, voice chats, I guess, is they don't have a lot of options. So they're claiming first mover advantage in voice-centric mobile social networking and entertainment. Innovative business model focusing on users' interaction and social networking experience, leading to a position in MENA. I need to look that up. I'm not sure what that is. MENA based, maybe the region. Anyway, okay. Let's scroll down a bit. So here is their product suite. So they have their social, voice chatting, Yalla Chat. Supports Arabic users in observing their customs. So it's very much tailored to a specific region, this specific region of the world. Turbo, Match 3D gaming. So they have mid-core and hardcore games and casual games. Hokage, Yalla means let's go. Okay, very cool. I did not know that. Pronounced Yalla. Am I saying that right? Yalla, not Yalla. Yalla. So common phrase used in the Middle East, similar to saying chop chop. Oh, okay. Chop chop. Okay, that's cool. Very good. Thank you for that insight, Hokage. Okay. So they've got games, you may have seen games that kind of visually look like this on your phone. These are just kind of your basic application games. So that's what they do. And they make a ton of money. Let's go to their financials really quick. Okay. income statement. So one of the first things that I look for is I go down to the margins. So number one, gross margins, operating margin, profit margin, free cash flow margin. These margins are massive, massive margins. They are consistently since, let's see, this is 2021. Their margins have been massive since 2021. Excuse me. It's like in 2020, they had a down year, but then, what was going on in 2020? I don't know, COVID, and then back up in 2019. So really, really, really strong looking company right off the bat. I also really like to look immediately at their interest expense, because if they have a lot of debt, then I see that as a major risk point. Interest and investment income. Okay, but where's their interest expense? I don't see any interest expense. So that is a really good sign. And then as I go to the balance sheet, I can see that if I go down to the long-term liabilities, I see no long-term liabilities, really. They have no debt. They have tons of profit. So this company is not really having a risk of going out of business because they can't service their debt. That pulls a major risk off the table, which I really like to see. We go to their cash flow statement. Another thing I like to look at is stock-based compensation. So as a percentage of their operating revenue, it's less than 10%. It is slightly high, but it's less than 10%. So they're not getting a huge percentage of their operating cash flow because of stock-based compensation. That's always a big red flag that I look for. Very minimal capital expenditures. That is a huge green flag. And how are they spending all this cash that they're bringing in? So over the trailing 12 months, they brought in $173 million. They are putting $20 million into investing in securities. They are putting $14 million into buying back shares of stock. So they've got a stock buyback program going on. They're investing in securities. They are generating tons of cash. What are they doing with all this cash? Free cash flow, $172 million. Their net cash flow is $178 million. So they've been building up a big cash position. So that is something that I guess I need to understand. Like, what is their plan with all this cash? Because right now I'm seeing $422 million right here in cash, $315 million in short-term investments. And yeah, this is in US dollars. So they've got $771 million in current assets, $869 million in assets, and then their liabilities are very low. So their shareholder equity, $777 million, while their market cap is $1 billion. So like their price to book ratio is pretty low. It's less than 2. So anyway, this company just on paper looked so good to me. But as I'm going through all these companies, I am painstakingly entering in this information and checking every single one for a discounted free cash flow valuation. So the first step is, I guess, let me quickly run through how I do my discounted free cash flow valuation. So when I'm projecting future free cash flows, it has 2 components. It has a revenue. First I project future revenue, and then I project their free cash flow margin. So whatever their profitability is, whatever percentage of revenue in the past they've been able to turn into free cash flow, I will apply that margin percentage going forward. So it's pretty simple. Generally, I will lean on analyst projections for future revenue, and I will use past performance for future margin. And then I will also look to see what analysts say about their future profitability. Sometimes you can see that analysts will say that they think their profitability will be, like their margins will be improving into the future or going down into the future. So in this case, I'm using 30% as my past free cash flow margin. Their average free cash flow margin over the past 5 years is 45, but I am lowering it significantly by 33%. So why am I doing that? So I adjust free cash flow margin by a few different metrics here. So first, sometimes I will give credit for research and development. If I think that they are spending a lot of money on R&D and it's going to lead to more free cash flows in the future, then I will treat a percentage of that spending as free cash flow, as like an investment. In this case, I'm not giving any credit for R&D, even though they've been spending not 8, 9, looks like they're spending increasingly more, a higher percentage of their revenue on R&D. I'm not giving them any credit for R&D. CapEx, sometimes I will give a percentage of CapEx as free cash flow if it is growth spending in capital expenditures. And then acquisitions, they haven't had any acquisitions, so that's not affecting anything. And then I will count stock-based compensation against. So in this case, they're spending, in the most recent year, 4% of their revenue went towards stock-based compensation. So I am counting 95% of stock-based compensation against free cash flow margin. And after making that adjustment, that brings the average way down. Now the average is 30% free cash flow margin. And if we look at the past 5 years, this 4%, so in 2020, this was COVID, their free cash flow margin was 4.5%. So this is dragging the average down significantly. The average is probably, let's see, what is the average? So it looks like the average is actually over 40% if I ignore this year. But in order to be conservative, I'm going to go with 30% free cash flow margin, even though 40% is probably closer to correct. Now, in terms of revenue growth, they have grown on average, they have grown their revenue by 20% over the last 5 years. Now, that is a little bit misleading. I do not think they're going to be able to grow their revenue by 20% going forward, because if I go to let's go back to their financials. If I look at their revenue growth, they had 100% revenue growth in 2021 and 100% revenue growth in 2020. So, that is bringing the average way up. So what I'm seeing is 11% and then 5 and then 6.5 and then 6. So I'm assuming their revenue growth, if I'm extrapolating forward based on past revenue growth, is probably closer to 5 or 6%. So what am I using for my model? I'm using 2%. So not only am I significantly reducing their free cash flow margin, I am projecting 2% revenue growth for years 1 through 5, 2% for 6 through 10, and 2% as my perpetual growth rate. All of this very conservative. Now, these projections go into this calculation right here. So based off of these incredibly conservative calculations, if my desire is an 8.25% return annually every year, then if that is all I want, then the fair share price today would be $13.31, which is an 88% upside. So if I look at their current share price, $7 a share. So using the most conservative outlook, I'm seeing a massive 88% upside. Now, just to see, now let's just say hypothetically, they do manage to maintain a 40% free cash flow margin. And let's say instead of 2% revenue growth, they hit 5% revenue growth, which is more in line with their past performance. We'll say a perpetual growth rate more in line with inflation, roughly 3%. And then years 6 through 10, I'll say 5% as well. Let's say this is like the base case. That would be a 200% upside, 200%. Now, on the average high analyst, if I look at the analyst high, average, and low, now on stockanalysis.com, they do not have a forecast section, unfortunately, so I don't have access to analyst projections for this company. On this website, normally I pull, high, average, and low and paste it in and use that as my calculation here. In this case, I just put in some random numbers. So I went with 5% loss or 5% reduction in revenue. For the low side, 5% increase in revenue for the high side, or for the average, and then 10% growth for the high side. So that's my spread, high, average, and low. 10% growth, 5% growth, or 5% loss. If I couple that with a 2% perpetual growth rate and a 2% growth rate in years 6 through 10, and let's put this back to 30%, then even with the average, with the low analyst projection, that's a 5% loss. I'm still seeing a 53% upside. It's just massive upsides. So one way that I have been getting more access to different analyst reports is on my Charles Schwab account. And so from the Charles Schwab account. And I also got a Morningstar account, which I've been pulling really interesting information off of for my stock research. But here we go. Okay, so off of my Charles Schwab, I have access to the LSEG Stock Report Plus. This company, Yalla Group, gets an average score of 10. So it's the first 10 that I've ever seen. And so they have several different metrics for this. Earnings have been good. Fundamental has been good. Relative valuation, risk, momentum, and insider trading is not reported, unfortunately. But anyway, the main thing I use this report for is they do give me some analyst projections here. So in this case, there are only 2 analysts that are weighing in on this company. The analyst projections for the stock price, their 12-month price targets are all very high. Now, as a value investor, I don't have 12-month price targets. I don't assume that the stock price is going to move up or down in the short term in the next year, but over the next 5 years, my projection is that the stock price will move to its intrinsic value based on my assumptions. And so what I would say is, based on my conservative assumptions, which is 30% margin, 2% growth, I would say it seems likely to me that this company will exceed these projections. So I think it's likely that at some point they will hit their intrinsic value, which is today the intrinsic value is 13.31, but next year that intrinsic value will have gone up by 8.25%, all things being equal. And then next year it will have gone up by 8.25 and so on and so on. So eventually this stock, unless new information comes out, I believe will hit my intrinsic value assumptions. So, okay, let me get back. I'm chasing butterflies here. I need to get back on track. So analyst projections, earnings per share. One analyst projects that earnings per share will increase. Okay, it's very helpful. Here we go. Annual revenue. 3 analysts are projecting 11% growth by 2026. That's the average projected growth. So if I'm saying the projected growth for 2025 is 2%, but by 2026, they're saying 11% growth. So 2% per year is way under 11%. This is like 4.5%, 5%. This is 5%, 5.5% per year. So analyst projection is 5% roughly. The next thing I like to look at is on Morningstar. So one thing I found on here is they give me access to the earnings transcript, which is very nice. So I can see questions, the Q&A from here. I can see the prepared statements, all very interesting. Let me see if I can quickly scroll through this. If I remember, there was something I wanted to point out here. They give their guidance. Oh yeah, I remember now. I wanted to look at their guidance. Okay, this is their third quarter 2025 reporting. Let's scroll down to their own guidance. The company's outlook right here. For the fourth quarter of 2025, Yalla currently expects revenues to be between 78 million and 85 million. So let's pick the midpoint there. That would be a midpoint of 81 and a half. So if they hit 81.5 million, what would be their revenue for the year? Oops, financials. So for 2024, they hit 340. If we go quarterly, I can't do this math in my head. Okay. Let's pull up the calculator app. Bear with me. All right. So they're saying they're going to hit, what did we say? 81.5, right? That's what I said the midpoint was. So 81.5 plus 89.64 plus 84.5 plus 83.88. That is 300 million is the analyst projection, or sorry, the company's projection, which is basically flat with fiscal year 2024. So the analysts are, and this company normally does beat their earnings projections. I think we saw that on on this report here. So this is probably correct. Forecasted growth 1.5% to 2% probably. So my 1 year price projection is probably in line with reality, but going forward, we are projecting greater revenue growth, and they do comment on their investments that they're making in the near term. Those investments are not going to start paying off until next year. And so I'll look at the transcript again here shortly. But where were we? Anyway. So yeah. So based on that, 2% revenue growth, 88% upside in the near term. Okay. Let's go to, here we go. All right. Now, at some point in here, they do discuss the investments that they're making going forward. Where is it? Our technology and product development instances were 8.6 million in the third quarter of 2025, a 21% increase. Mainly staff and headcount to support the development of new businesses and expansion of our portfolio. R&D development expenses as a percentage of total revenue increased to about 10% in the third quarter. So they are ramping up their R&D. I did not give them any credit for R&D in the free cash flow calculation. I probably should give them some credit, but I don't know that it would make a huge difference on their margin. Okay. Where is it? As of November 7th, 2025, the company had cumulatively complete cash repurchases in the open market of 15 million, representing Class A ordinary shares. So they are having a share buyback program, which I'm really thankful that they're doing share buybacks instead of a dividend, because I'm calculating the share price to be drastically undervalued. So this, in my opinion, is a very tax efficient way to return value to shareholders, is buying back shares, especially when they are insanely undervalued. Okay. Question and answer section. Okay. Can management brief us on the advancements in mid-core and hardcore games? During the quarter, we soft launched 2 Match 3 titles as fans, marking a significant step forward in our mid and hardcore gaming portfolio. Turbo Match stood out. As a result, we decided to invest more resources to focus on Turbo Match in the next stage. Based on test data, we're adding levels and diversifying side gameplay options, set the stage for the next wave of large-scale user acquisition. So meanwhile, our roguelike product is expected to launch. We have recently completed a round of testing for our collaborative project. Given our expectations for this title, we are working closely with the content provider to refine its gameplay, visuals, etc. We plan to launch it by the end of the year. It will take some time for this new product to generate meaningful revenue. For those expecting loadable revenue impact from these new games, we see the second quarter of 2026 as a key inflection point. So what they're saying is, this is an important data point for me as an investor. So they are saying revenue is going to really start picking up in the second quarter of next year. So this quarter, it's pretty flat. The analyst expectations are showing it to be pretty flat right here. They're showing pretty flat. They're showing it to start picking up in 2026. When should I expect to see that? I should expect to see that in the second quarter. So I'm going to be looking closely at this stock in the next 4 to 6 months to see what kind of information is coming out. Are they indeed increasing their revenue? Are they seeing meaningful results from their investments into their new games that they're rolling out, mid-core and hardcore? At this time, even though they have not hit their inflection point yet, this company is so undervalued. I would consider it to be, risky, which is why I'm only putting a small percentage of my portfolio into this stock. But the goal is to find, 10, 20 small cap companies that all appear to be deep value stocks. That way I can spread my risk out over several. And that way, if one or two don't pan out and I end up losing money, my portfolio doesn't get significantly hurt by just one or two companies that don't pan out. And then the other ones, if they are in fact deep value and I'm getting, 88% returns, let's say, or 100% returns over 2 years, that will more than make up for losing 10, 20, 30% on one or two. So that is the plan. That is my latest strategy for finding deep value stocks. I'm going to be really grinding, looking through as many different tickers as I can that meet my kind of rough criteria for revenue growth. And then I'm going to be checking each one manually for, is it a value company at this time? That's my plan. If anybody has any questions or if anybody has any companies that they want me to check out while we are streaming, I'd be more than happy to analyze a company or two live. But yeah, in the meantime, I'm going to quickly let's review my public YouTube portfolio in the meantime while I'm waiting for any stock suggestions to come in. One sec while I pull it up. Okay. Okay, M1. So Hokage, have you ever heard of this Yala company? Also, let me know if I'm saying that right. Okay. All right, here it is. The public YouTube portfolio. Okay, $6.3 thousand. We've been investing roughly $100 per week. Some weeks we go above that. I try to invest $100 in a different company every single week. Some weeks I will also double down. I'll put an extra $100 into one of my existing holdings that has gone down in value, but I still feel like it is even more undervalued, let's say. Hokage says, no, haven't heard of Yala. I think this company is significantly undervalued, and I'm curious if you see any red flags that I am missing. And one thing I forgot to bring up. So I also have on my automated spreadsheet, I have my Warren Buffett supplement where I have it. This spreadsheet automatically calculates red flags and green flags based on Warren Buffett's criteria whenever he's looking at the income statement, the balance sheet, the cash flow statement. And so it's pretty straightforward. It goes back 5 years. If a cell is highlighted green, it's a green flag. If it's highlighted red, it's a red flag. If it's white, it's neutral. And on Yala, I'm seeing a lot of green flags. So he wants to see gross margin above 40. He wants to see interest as close to zero as possible. Interest expense as a percentage of operating income, which in this case is zero. That's really good news. 40% profit margin is incredibly strong. Warren Buffett wants to see above 20. Profits have been going up consistently. Earnings per share has been going up consistently. Long-term debt, like we said, is zero. Retained earnings has been going up consistently. Yeah, that's the... Oh, wait, what am I looking at? Yeah, retained earnings is in blue. It's been going up. That's always good. Inventory versus profit. So this company doesn't really have inventory, so that graph doesn't really make sense. Debt versus cash. Cash holding, they have a significant amount of cash. I'm curious what they are going to do with all that cash, because they did not, $654 million. They did not mention that they were going to be putting that much money into share buybacks. So I'm curious, like, they've just got so much cash. What are they going to do with it? I don't think I saw anything about that much in the buyback program. Let's see. Let me go back to the... Oh, wait, no. Do they call it repurchase? Yeah. Okay. Oh, an update on our 160 million shareholder return program, which we continue to execute. As of November 7th, the company has repurchased 7.7 million Class A shares totaling 52 million USD, achieving our full year 2025 repurchase commitment of 50 million USD well ahead of schedule. So they hit their 50 million ahead of schedule. We will cancel all share repurchased. Wait, as we mentioned on our last call, we will cancel all shares repurchased in 2025, and we have canceled a total of more than 6.2 million shares. What do they mean by that? We will cancel all shares repurchased. Oh, I see what they're saying. At least I'm pretty sure I understand. So when they repurchase shares, let's dive into this really quick. Hokage says, on your YouTube public portfolio anniversary, maybe we can have a summary, possible rebalancing episode for the new year. That's a great idea. I think the reason there is no debt is because in Middle East, it is considered a taboo to earn money through interest. Probably a company is owned by rich people. Interesting. I'll have to look into that. It's very interesting. Well, no debt. I like the sound of that. They do have investments, but I guess investments is different than, they have interest and investment income. That might not necessarily be interest. That may be something else. Interesting. Okay, what was I saying? So when they say cancel shares that they're repurchased, if I go to the balance sheet, right? This is on the balance sheet, treasury stock. Okay. So treasury stock, this is shares that have been bought back. And if they're buying back shares, you would expect to see this number get increasingly negative. But as we go from this year to this year, we saw that it actually reduced. So it went from negative 49 to negative 34. So they are retiring shares. That's my understanding. So if they retire shares, then they can't reissue them. I hope I'm not talking out my butt. I'm pretty sure that's what they mean. Maybe I shouldn't speculate while I'm streaming. Maybe I should look that up. Take that with a grain of salt. I'm pretty sure that's what they mean. Okay. Hokage says you can make money through profit sharing. That's allowed, but not by lending and earning via interest. I'll be damned. Okay. The aggregate value remaining available to purchase under the current share repurchase program was 48 million at the end of November 10th. For the next year, we expect to maintain a similar level of repurchases as in 2025. We are on track to complete our 150 USD share repurchase program within the next year, at which point we plan to launch a new program. As always, I want to emphasize that we will continue to place shareholder interest at the core of our capital allocation decision. So they will be completing their 150 and then, and then they will be doing even more. So, hey, that still does not account for all the cash that they have. Another 50 million in the next year. Excuse me. They have $737 million in cash and short-term investments. What are they doing with all that? I need to look. That'll be my homework for after the stream. What are they doing with all of that cash? Okay, where was I? Oh yeah. Let's look at the portfolio. All right. So we're at nearly $6.4 thousand. The goal is to get to 10K and then increase the investment. So we were doing roughly 100. I cheat some weeks and do like another 100. Maybe we'll up it to like $250 per week. Or maybe I'll up it on the anniversary. I think that's the good idea, Hokage. This account started in December 10th. So maybe on December 10th of this year, we'll see where we got after 1 year. We'll do a rebalance. We will review our highest performing shares. We'll review our lowest performing shares and see if we want to make any changes. And maybe we will up the weekly contribution. I'm thinking maybe $250 a week. The goal was to get to 10K at $100, but man, I don't know if I want to wait. Okay, let's look at the holdings. Okay, let's look at the holdings. Google has now upped its way into our number one holding. Really happy with Google. ASML, BTI, UHS. HIMS used to be our top dog, but it has since come down a bit. My plan with HIMS was to wait until I had held it for a year before I sold it so that I could avoid, short-term capital gains. But it turns out, in hindsight, should have sold some when I had the chance. However, I still like it. Still like it as a long-term holding, and this will be one that I review for sure at the anniversary to see if I still would consider it to be undervalued, and then maybe we trim the position a bit. But let's scroll down to our worst performers. That's where it's most interesting. Okay, nice. This is one that came up on my screener, did it not? Nice. Yes. So this is another small cap company that I invested in. Excuse me. Oh. Okay. Nice is another software application company, small cap, a lot of volume though, over 1 million in volume. So it is somewhat traded. Actually, I guess that's technically a mid cap. Oops. What happened there? Nice. Open link in new tab. So the forecast on Nice, the revenue projections all look really good. So the average analyst is saying, upper single digit revenue increases. If I go to my discounted free cash flow spreadsheet, put in Nice, this one also looks just so strong. Okay. Let's look at the margin. So R&D, we're going to give them zero. No, we'll give them 10% back on R&D. We're going to give them 0 in CapEx. We're going to take away 0 on acquisitions, and we're going to take away 95% on stock-based compensation. This puts their average at 19. Lately, they've upped their free cash flow margin percentage up to 24%, but we'll keep it at 19 for the sake of this analysis. 19%. If we see 2% revenue growth, which is quite low, then there is a 31% potential upside, and that is so conservative, this 2%. Now, this is not as crazy of as an upside as Yalla, but this company is incredibly strong. And if I use their the analyst projections here for revenue, then it looks even better. So yeah, I'm using 2%, which is below the lowest analyst, just for a record here. So let's put this in. And they only give 3 years, so I'm gonna have to fill in the next. I'm gonna have to fill in the next 2. So these 2, just keep in mind, these 2 I have pulled out of my butt. But there we go. 5 years. We'll up this to 3. Oh, we'll make this 5. So I'm using the analyst projections for revenue over the next 5 years. I'm using my projection of 5% for years 6 through 10. I'm using a 3% perpetual growth rate with the 19% free cash flow margin, even though more recently they've hit 24%. Based on those projections, the lowest analyst projections are showing 64% upside. The highest are showing 147% upside. So nice holdings, even though this company is, one of my worst performers. I think this company looks so strong, especially at this price level, super undervalued. CoreWeave, this one was, I only invested $100 in this one, and I will not be investing anymore. This one was a speculative investment. I used a price to sales, a price to sales ratio valuation metric for this one. And since we've seen a lot of the AI companies like NVIDIA come down a bit. Core and Palantir, CoreWeave, some of the more speculative AI companies have dropped down quite a bit recently. So I'll have to look at this one again. I don't think I'll be putting any more in it because this one is, like I said, not a traditional value investment, pretty risky. So that's my thought on CoreWeave. Simply Good Foods. Let's look at this one again. And then, well, no, I looked at Simply Good Foods last time. Let's look at IRDM. How is Iridium looking? Iridium Communications forecast. So in terms of analyst revenue projections, here we go. Low to mid single digit revenue growth is what the average analyst is thinking. Let's paste that into the spreadsheet. Okay, R&D, 10%, CapEx. So with this company, CapEx is pretty significant, if I do remember. Just as a quick refresher, Iridium Communications provides mobile voice and data communication services and products to businesses. The company offers mobile satellite communication services for land mobile and end users amid aviation sectors. So in this case, I'm tempted to give some credit back for CapEx, but I don't think I will, just because if they're not putting satellites in the air, then they don't have a business. So I'm going to say that's just their cost of business. I'm not going to give them any credit for that. Not going to give them any credit for acquisitions. Stock-based compensation is counted against them per usual. That puts their average at 32%. Okay, 32%. Their past revenue growth was 7%. For my first look here, I'm going to put just 2% revenue growth. And based on 2% revenue growth at 32% free cash flow margin, we are seeing a 45% upside, which is just huge, huge upside. But if I go with the average analyst projections, that is utilizing these estimates right here. We'll say years 6 through 10, I'll put at 2%. Here is the spread. So the highest analyst revenue gives me a 210% upside. Average gives me a 100% upside. Low gives me 11% upside. So I am still reading that Iridium is still undervalued. Like it still looks really strong on paper in terms of analyst projections as well. On the Buffett supplement, everything looks really good in this year, except for they have very high interest expense. So that is their one red flag. They have lots of long-term debt to finance their satellites. So that is a potential red flag. Lots of CapEx, and with that comes lots of depreciation. So they are a capital intensive company. So they are not without red flags. Let's see. Not the highest return on invested capital either. Their price to book, 3.8. So it's not without its risks. It has some risks. So it looks undervalued on paper, but it has its fair share of risks. Because of that, if this was like nothing but green, then this might be a company that I would double down on. But I think I'm happy just to leave it where it is. Just $100, a tiny percentage of this portfolio. So it's currently down. We'll leave it where it's at. Okage says, I see interest rate cuts delay probably affecting Iridium. Yeah, I think you're probably right on that. I think you're probably right. So that's all I got for today. But yeah, the takeaway here is, as individual small money investors, I think our greatest advantage is to sift through the small cap stocks. It's a lot of work, but that's going to be where we have our greatest advantage, because the big dogs can't go through these waters. This is shallow waters. The whales can't go here. So we've got less attention, less competition. There's just a way higher likelihood that we're going to find companies that are deep value stocks in the small cap waters. And yeah, I'll be looking at mid caps too, but small caps. That's where I'm going to be focusing. Maybe next week, I'll see what I can find with a low volume filter. I think that's going to be my plan. Gosh, y'all offer now. Happy Thanksgiving. Happy Thanksgiving to you too, buddy. Will I be streaming next week? Yes, I will be streaming on Wednesday. I hope to see you then. Until next time, happy Thanksgiving.